Welcome back to chapter 12. Again, I thought it would be easier to break this out, but I'll try to keep playing with this in the future and make it a little bit shorter so it's a little bit easier to sit and watch these segments. I know it gets really boring. We left off last time talking about cash surrender value and non-forfeiture on policies, especially these would be on the whole life insurance policy. Hold on, just bear with me a second as I get this up and running. Okay, talk a little bit about cash surrender value. So that's that payment that you can cash out of your whole life insurance policy. You actually withdraw money. What's the full cash surrender value? It's not a loan. You're actually saying, you know what, I don't need the insurance policy anymore and I just want to take the cash value and walk away. You have the right to do that, take that accumulated cash value. Most states have a standard non-forfeiture law in place. We can use those terms interchangeably, non-forfeiture value or cash surrender value, same thing. Most policyholders have three different non-forfeiture options. They can do a immediate cash value. They could reduce the amount of insurance that they have in the paid up policy. Or they could, so basically they're taking a $100,000 policy and saying, what have I paid up to that point? Maybe it's worth $80,000 and I'll take that. Or I can extend the term of the insurance, which we'll go through some examples of how that would work with some tables. It's a little bit hard to explain without looking at the dollar amounts. So let's focus on, it's a $100,000 policy. It's a typical male, 37 years old. It's an ordinary type policy, which again, it would be a whole life ordinary policy, not a term. So year one of the policy, and it carries it out all the way to age 65. First option we mentioned was cash value. That's your first. If I, at age 65, I'm getting ready to retire, I can walk away, and at that point, if I'm paid in all these years from age 37 to age 65, the value of my policy would be $41,700. I could walk away with that cash in my pocket and use it for a camper or an exotic trip or put it in my investment portfolio. But either way, it's money that's yours. Another option, we said option two would be the reduced paid up insurance. So this is basically telling me rather than having a $100,000 payout, I could choose to have a paid up insurance. Basically, it's worth $77,300 that'll carry me out until I pass away. And my beneficiaries would get, instead of the $100,000 value, they'll get the $77,300 and they're done paying. They don't have to pay anymore. Another option is I want it to be extended out longer than the original end of policy period. So rather than carrying it out to age 65, I want it to extend longer for another 13 years and 198 days. So essentially that extends it to age 78 and 198 days. So those are my three options. Again, it really depends on what your specific goals and objectives are on the cash out. All right, talk a little bit about settlement options. So this is where, especially if you're a young parent trying to figure out what do I want to happen in the event of my death, you need to do a little financial planning. It'd be good to talk to a financial advisor of what your goals are, what would be the smartest thing for your family. You could choose this at any time, and you can decide how you want your beneficiaries to get the money if you're the owner, or you could grant that choice to your beneficiary where they get to choose at the time of your death. We'll go through some of the common options. The most common would be a lump sum cash payout. So your family has immediate cash needs. You pass away, your spouse doesn't work, you have funeral expenses, you have a mortgage to cover. You can take the cash value out and use that money immediately. Another option would be interest option, where The policy proceeds are retained by the insurance company. They keep that $100,000 rather than getting paid out. And they periodically pay the earnings or interest on that to the beneficiary. So it's no different than an investment account. If you had an investment portfolio, you would only live off the earnings of that investment portfolio. Maybe that's what you want your family to have. You already have other substantial assets, and really it's just an extra cushion for them to have money coming in to help out. Those interest payments could be paid out monthly or annually, and most insurance companies have to give you a guaranteed interest rate. It's kind of like an annuity. They have to guarantee you a certain amount. We also have an option of a fixed period option where you say, I'm going to give my beneficiary proceeds for a fixed period of time. Maybe it's 10 years, 20 years. So you and your spouse buy this policy and you want to make sure it gets it through till your kids are out of college. So you pick a period of time that would get you through, and essentially they would get that payout. It would give them as much as they need through that period of time. We'll go through some more examples in a moment. Another one would be a fixed amount option. So if you, a fixed amount is paid out periodically. Maybe you say, I want X amount of dollars paid out to my family over this period of time. They only need a certain amount to live on, and this would cover them for the period of time that I want. So it's a fixed dollar amount versus then compared to a fixed period of time. And then we'll get into the life income options where, do I want my beneficiary to have income for the remainder of their life, or do I want to have income for a guaranteed period of time, or do I want to only have it where my spouse, and let's say I choose joint survivor income, I want one of us to have income until the other one passes away, and then we don't care about who the other beneficiary is. So these are some of the settlement options that are available. Let's first go through the income for elected periods. So this would be a fixed period, and I wish I had a way to, I'm not that savvy to put that on here, but I'm gonna go through. This table represents how much your minimum monthly payment would be to your beneficiary for each $1,000 of proceeds. So let's say we have a $100,000 policy. I keep going back to that size just for ease of calculation. If I have a $100,000 policy and I break it out into $1,000 increments, you're talking about 100 units at $1,000 a piece. So if I have 100 times the rate, let's say I want, for a 5-year period, I want my family to have, maybe my kids are almost out of college, I want for 5 years them to have a guaranteed income. If I take those 100 units and multiply it by 18.12, I essentially would be giving them $1,812 per month for the next 5 years. That's one option. But maybe my kids are young, and not only do I want to get them through college, I want to get my spouse through to Social Security. So maybe you want to, you're 35 or so and you want to get them through to Social Security. You could say, I want to pay out the same 100,000 in 100 units at $1,000 a piece, but I'm going to only get $4.45 for each 1,000. That would equate to $445 per month. This is a monthly, for the next 30 years. So it's obviously substantially less than the 5-year payout, but it gives a more steady income for your beneficiary if you want it to stretch longer. All right, let's talk a little bit more about the life income. So these would be installment payments made to your beneficiary while they're alive, and then after they die, then all of the settlements go away. It's very similar to retirement plans, which we'll talk about in a future chapter. You can choose to get your retirement payouts until the day you die. You could have them extend for a certain period of time for your spouse, or they could be there for the remainder of your spouse's life, whatever you choose. And these options, first one I'll mention is life income with a guaranteed period. So I'm going to guarantee them a certain amount of money only for a certain period of time. Maybe I'm only going to let them have money until the age of 65 or until the age of 80, whatever I choose. And then any payments that are paid, let's say that person dies before the end of that guaranteed period, your beneficiary, your primary dies, it's guaranteed that it'll continue to pay out until that period of time's over. So any monies that didn't get paid out to your primary would go to your contingent beneficiary. So nobody loses the money. Another one could be the life income with a guaranteed total amount. So if the beneficiary dies before receiving all of the installments equal to the amount that they're supposed to get paid out, the payments will continue until the total amount's paid out, or the face value. It's not based on I'm going to get a certain amount each month. It's going to be until I reach the total face value, I'm going to keep paying. And the last one, that joint survivor, is, income payments are paid to two people during their lifetime, and they get an income annuity if one of them dies, and the other still receives that monthly annuity during their lifetime. So after they both die, it's gone. But those are different options that you can choose depending on your personal life and goals. All right, I'll go through a few more examples. So if we were to choose the life income guarantee, this is again monthly projection with $1,000 per $1,000 of value, insurance value. So if I had a $100,000 policy, I could pick, that's 100 units. I could say, you know what, I want a guaranteed payout for 5 years. And let's assume that you are a female. You want a guarantee for, I'm age 60, and I want, at the age 60, I want them to have a guaranteed 5-year payout to get them to age 65. They would be getting $468 a month for the next 5 years. Or you could say, you know what, I want for the next 20 years for my spouse to get a payout for 30 years. They would get $4.54 per month, or times 100, $454 a month for the next 20 years. But if the beneficiary dies after 10 years, anything that's left over, that $454, would go to the contingent beneficiary. So the whole point is they're going to get the money for the period of time that's promised. And even if you picked 5, let's say you bought it and your spouse dies within a year, those dollar amounts are going to continue to be paid out to the contingent beneficiary until that period of time is up. The 5 years, 10 years, 15, or 20. Having the guaranteed total amount. So like again, I said we pick, if it's a $100,000 policy, we want to guarantee that they're going to get, until they reach that $100,000 payout, they're going to continue to pay out so much per month. If you were a 60-year-old female, you're going to get that $4.57 per 100. So you're going to get $457 a month until the $100,000 total value of the policy is reached. If you were 85 or older, you're going to get $835 a month until you reach that $100,000, because you have a shorter life period, so they're going to have to pay out quicker to get to the $100,000. Again, there's still risk in that, but whatever's left over would go to the beneficiary if the $100,000 total life insurance face value hasn't been met. And then real quick, I'll point out the joint survivor. So you'll notice there's a matrix. We've got a female payee's adjusted age, 60, 65, 70. You have the male payee's adjusted age. So depending on your combination, maybe it's a younger female and an older male. I've got a 6-year-old female and an 80-year-old male. This is the rate that they're going to pay, the minimum, or that's going to be paid out, the minimum monthly payment per thousand. Again, let's use the $100,000 insurance policy. They're going to be essentially getting paid $461 a month until the spouse, who's the youngest spouse, most likely would die. It could be that the 60-year-old dies first, but that's what they're going to get per month. If they're both closer to 80, they're both 80 years old when they do this, they're going to get more per month based on their elevated age, because they get it paid out quicker. So what are the advantages of each of those? So, picking a settlement option really is important on financial planning. And I'll point this out, that if you give your family a lump sum, it may not always be used to help them. It might be if they're good financial investors, maybe your spouse is very responsible, but you don't always have that situation. What if the parents pass away and you're left with minor children? Is it smart to give an 18-year-old a lot of money? Now, you guys are going to argue that it is probably, but maybe you've proven that it's probably not in their best interest. You need to space out their payments. So having periodic payments helps restore financial security for families. Rather than giving them a big lump sum that they may spend on things, you could actually space it out by giving them something over a period of time to keep them sustained over a period that they need it. The good part of that is you have principal and interest is guaranteed. You make sure, rather than if you give them a lump sum, you don't know what's going to be left after 2 years. That could all be spent. It's really helpful in planning for your financial security for your family. You also, what we found is when people get a larger sum of money, like the lottery, all of a sudden people come out of the woodwork, or you spend things that you don't necessarily wouldn't spend money on. So insurance windfalls can create problems for the beneficiary. They don't know how to manage the money. Maybe they run through it faster than they need to, and it causes a hardship. So the disadvantages of having that settlement where you're stretching it out is maybe you're not getting the interest rates that you'd planned, that you could have gotten somewhere else. So maybe you want to put it in a different type of arrangement. If you set up an agreement and it doesn't work well, it's so inflexible and restricted that your family couldn't really change it down the road and it won't meet their needs. And life income options where your payout have limited usefulness for younger age, primarily because their income payments are substantially reduced, and they, unless you're closer to 65, they usually aren't very good. The reason I think it's important, and I'll point out, is that especially if you have young children, maybe both the parents pass away and you're leaving it to a guardian, you're not sure how the guardian will handle it. It's good to kind of have that set up and that they don't get all of it at once. Another really good way to control and manage the money on behalf of your family and your beneficiaries would be setting up the policy that's in the name of the trust, a trustee such as a bank. Now, you could also do this by setting up an irrevocable trust, which any of your assets in your estate would go to, and would ensure that your family gets what they need over a period of time to make sure your kids get to go to college and make sure that they have adequate income over a period of time. But again, all of these are investment options that you should be exploring with your financial advisor. If you're using a trust, it might be desirable if it's a large amount of insurance that you shouldn't be able to manage well on your own. You probably need a financial advisor. And maybe the flexibility and timing, you need that discretion, or that they don't get it, but you also want to make sure they get the monies when they need it. So having a trust that actually can be a sounding board, instead of it being locked down, you could actually go to the bank, make a justification of why you need the money. My son is just enrolled in college and I need to have a larger payment. There's more flexibility in having a trust arrangement than you would in a normal settlement option. And if you have minor children, or you have mentally and physically challenged adults that you're responsible for, they probably can't manage your own financial affairs. So having a trustee would be a really good option, and they'd be able to better manage the money. There's a few other additional life insurance benefits that aren't always mentioned or people aren't aware of. These can be added to your policy for an additional premium. The first is, let's say I become disabled for a period of time, I get hurt in a car wreck, and I cannot make the payments on my insurance policy. You could actually set it up that if that provision's in there, you're paying for a premium for this, but if I can't pay them because I'm physically disabled, fully physically disabled, all of my premiums that are due would be waived. And it wouldn't change the effect of life insurance. So that's a good provision to have in case something bad happens. You also could have a guaranteed purchase option, which permits you to be able to purchase additional amounts of life insurance at certain periods of time. So maybe you place the policy when you're young, and allows you every 3 years to increase it, add another layer. And what that does is it allows you to kind of increase your value over time based on your growing family or your increased financial obligations. Another real common additional benefit that people pay for, it's not always popular with the financial advisors, and I'll tell you why in a moment. It's called an accidental death benefit rider. Another term for that is double indemnity. So what it means is that if I die as a result of an accident rather than natural causes or health condition, I die in a car wreck or I die in an airplane accident, it would double the amount of my face value. So if I have a $100,000 policy, I'm going to get paid $200,000 for an accident. Now keep in mind, in order to have that accidental death benefit, it used to be real common. It was given to you for free because it's so rare that someone's going to get killed in an accident compared to the likelihood that they're going to die from a health condition. So insurance companies just throw it in for free. In the last 5 years, that has changed. And now they've decided that in order to have that additional benefit, you have to pay for it. And I actually kept it for several years because it's really small dollar amount. But as I've gotten older, it becomes higher. And I've decided it isn't really worth the benefit. And here's the other reason why financial advisors don't like it. Like I said, death has to be caused directly and separately than the accident. So let's say, like I said, if it's caused by a disease, it's not going to be paid. So as an example, if I fall off a ladder or scaffolding, then I would be covered in a double indemnity because I had an accident, I fell off something, it was an accident. But if I have a heart attack and fall off the ladder, that would not be paid out as a double indemnity because the cause of the accident really was a health related, not an accident itself. So we hear that sometimes people have a heart attack and they're driving the car and they get killed or something like that. Those would not be considered an accident. And the death has to occur within 1 year of the accident, and also it must occur before some age. So the accidental death and benefit rider only is there for a certain period of time. The other reason financial planners do not like it is because it's a very low cost typically, but like I said, your economic value of your life doesn't double because you've had an accident. You died, you still have the same financial requirement, so why would you pay in there? Just pick the amount of insurance that you really need and don't pay them the extra money. Most people do die of disease, so it's a very small probability that it's going to be, basically you're gambling on that I'm going to get an extra bonus if I die of an accident. And a lot of times people believe they have more insurance than they do by having this, thinking, oh, I've got a $200,000 double indemnity policy, but really they only have $100,000 if they die of the normal causes. Another one is cost of living rider. So this is a good one. Rather than worrying about, do I have enough life insurance over a period of time, you can put it and tie it to an index. So if the consumer price index goes up over time, then you can have it automatically raise the dollar value of your policy without having to reevaluate it every time. And the last one is an accelerated death benefits rider. And this actually happened to a dear friend of mine who at a fairly young age found out they had a terminal illness that they were not going to recover from, and decided, you know what, I've paid all this money in and I'm going to take out an early withdrawal from my retirement plan, which you can do also. And I might as well, although I get less dollar value, I can sometimes take out anywhere from 25 to 50%. But you get to use that money and enjoy your life while you're still alive, especially if you don't have beneficiaries that need to leave it to. So maybe you take the money out and you can quit working, or you can take a trip or do some kind of special thing that you want to do with your family before you actually pass away. So there are some trigger items that cause that. You know, your terminal illness, it has to be that you're going to expect to die within 24 months. It has to be related to an acute illness such as heart disease or cancer. It has to be a catastrophic illness, could be like a transplant. It's high risk that you're going to probability that you could die. Or you can need long-term care, such as nursing home confinement. Last thing, there's some additional benefits here. So a viatical settlement is where you actually sell of your life insurance policy. You're terminally ill and someone is going, it's basically they're betting on your life. How much longer are you going to live? They know you're terminally ill. They decide to invest in it with the hopes that they're going to earn a profit by you dying early. Now, I know I can see the problem with this. That's a very huge, that's someone's betting on your life and when you're going to die. And to me, there's ethical concerns there that most people wouldn't want to take. A life settlement is, again, another option where the policyholder who no longer needs or wants to have a life insurance policy, they can actually sell their policy to a third party for one that has more, for more than its cash value. So let's say they have $20,000 built up, they could sell it to somebody else and for $30,000, and they know you're going to live for a certain period of time, and they'll collect more over time. Problem with that again is there's moral hazards involved there. They have some tied to you dying, and a lot of states don't allow these additional benefits or provisions, but there's something that's out there, so kind of leery of them, but just be aware that they're not a good investment, in my opinion. That's all I have for the end of chapter 12. I'm going to post these, and really, I'm going to give you a little bit longer period to review them. It'll carry you into the next week, which will be at the end of the 10th, actually the 12th, the Easter weekend. I am going to post another chapter, but let me know if I'm throwing too much at you. These are what we normally would cover in a chapter or just thereabouts a chapter each class period. So I'm going to continue to try to catch up to where we should have been if we hadn't taken an extra week off. But feel free to reach out to me if you're having any challenges or if I can help in any way. Thanks, and have a good week. Talk to you later.